Okay, let's dive right into this explainer. Today, we're putting on your expert investment analyst hats and subjecting Norfolk Southern to a rigorous, no-holds-barred financial stress test. We're going to break down the company's fundamentals using the proven, time-tested frameworks of legendary investors. Think Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some hard quantitative models like the discounted cash flow analysis.
Now, our starting point here is truly fascinating. If you go and pull up the stock ticker for Norfolk Southern right now, the current market price is sitting incredibly high at $340.24 per share. At that price tag, the total market capitalization is hovering right around $76 billion. It's a massive valuation.
But this creates an immediate mystery for our analysis. See, Union Pacific recently proposed this blockbuster merger, right? They offered to buy Norfolk Southern in a stock and cash deal valued at roughly $85 billion. When you break that down, it comes to exactly $320 per share. So you have to ask yourself, why on earth is the market pricing the stock $20 higher than a hard premium buyout offer?
Well, to solve this mystery, here's our agenda. First, a quick company snapshot. Second, applying the guru lenses. Third, a DCF valuation. Fourth, alternative models. And finally, our final verdict. Let's get into it.
Section 1. Company Snapshot and NSC's Operating Reality. Let's establish exactly what kind of business we are evaluating today.
So Norfolk Southern is this massive Class 1 railway operating across 22 states, just a giant footprint. Looking at their recent Q1 2026 earnings, they posted flat revenues of $3 billion and an adjusted EPS of $2.65. Now, that slightly beats estimates, but it shows virtually zero top-line growth. They are navigating some extreme crosscurrents right now. They're fighting inflation, dealing with massive fuel price spikes, all while sitting right at the center of this pending mega merger with Union Pacific.
Moving on to Section 2, the guru lenses. Let's see if Buffett, Lynch, or Graham would touch this stock at today's prices.
First up, if we put on our Warren Buffett glasses, we actually see a company he would absolutely love. From a qualitative standpoint, Buffett always looks for a wide economic moat. And as a major Class 1 railroad, Norfolk Southern essentially operates in a duopoly in the East. It's a fantastic competitive advantage. They boast a really strong 18.3% return on equity, a totally manageable debt-to-equity ratio of 1.04, and consistent expected owner earnings of roughly $12 a share for the year. Plus, management just reported a stellar 37% improvement in safety metrics. So, great business, right? But remember, Buffett always requires a margin of safety on the price, which we'll calculate in just a bit. Now, before we look through Peter Lynch's lens, we need to quickly talk about his favorite tool, the PEG ratio. This metric is just a stock's price-to-earnings ratio divided by its expected earnings growth rate. Lynch essentially uses this to spot stocks where the underlying growth of the business outpaces the actual price tag. Ideally, he's looking for a PEG ratio below 1.
And this brings us to a crucial point. Norfolk Southern's PEG ratio is an alarming 5.97. Seriously, that is nearly 6 times higher than Lynch's ideal threshold. This metric is practically screaming that you are paying a massive, massive premium for a company with very slow, almost totally flat growth.
So applying the rest of Peter Lynch's framework, he'd categorize this company as a stalwart, meaning a large, slow-growing entity. Because of that sky-high PEG ratio, flat intermodal volume shipments, and really high institutional ownership sitting at over 75%, well, Lynch typically dislikes that because it means the quote-unquote smart money has already bid the price up. He would likely classify this stock as an absolute avoid. The only positive in his playbook here is the M&A catalyst, but at $340, the verdict is firmly a sell.
Okay, let's pivot and take a strict Benjamin Graham defensive posture. This checklist brilliantly illustrates how the company fails the conservative value test. Graham wants an adequate enterprise size, which at $76 billion, they pass easily. He wants a stable dividend, which they have at $5.40 a year. But look at the failures. Graham demands a current ratio over 2 to ensure strong short-term liquidity. Norfolk Southern sits at a dangerously weak 0.91, and he demands a PE strictly under 15, right now is trading at an expensive 27.62 multiple.
Graham also relies on a strict intrinsic value formula. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. We assumed a book value per share of roughly $65.57 based on their ROE metrics and projected EPS at $12. When you plug all that into Graham's formula,
It spits out an intrinsic value of just $132.86. Guys, that is less than half the current trading price. There's absolutely zero margin of safety here for a deep value investor.
Section 3. DCF Valuation. Let's strip away the guru rules for a minute and build a base case model purely on projected discounted cash flows.
Because our primary sources don't provide a multi-year cash flow forecast, I'm going to explicitly call out the conservative assumptions we use to build this model. Step 1. We project near-term growth at 3% based on that $12 EPS. Step 2. We calculate the terminal value assuming a 2% perpetual growth rate, which aligns perfectly with long-term GDP. And finally, Step 3. We discount it all back to the present day using an 8% weighted average cost of capital.
Based on those perfectly reasonable, slightly conservative assumptions, our DCF model produces a fair value of roughly $245 per share. Now, while this is significantly higher than Graham's super strict formula, it still clearly signals that the stock is deeply, deeply overvalued right now at its current $340 market price.
Now, I love this sensitivity table because it brilliantly illustrates why valuation is an art, not just a science. It shows how changing your assumptions by just 1% swings the fair value by literally over $100. If we lower our cost of capital to 7% and boast terminal growth to 2.5%, yeah, we can stretch the fair value up to $345, but you have to assume a perfect, risk-free economic environment to justify the stock's current price organically.
Let's look at Section 4, Alternative Valuation Methods. We really want to see if any standard financial model justifies this elevated stock price.
So we ran two more models. First, the dividend discount model, which prices the stock based entirely on its $5.40 dividend growing at 5%. That yields a fair value of only $175. Next, if we just assume the stock naturally reverts to a standard historical rail multiple of 20 times its $12 EPS, we get $240. Only the hard M&A buyout offer of $320 even comes close to current trading levels.
Finally, Section 5, Final Verdict. It's time to synthesize all this math and weigh the risks against the rewards.
Before we reveal the final numbers, we absolutely must acknowledge the operational risks operating in the background here. In their recent call, management noted sharp fuel price headwinds eating into their operating ratio. We also have flat overall volume, with key intermodal shipments actually down 4%. And perhaps most worryingly, recent USDA data shows Norfolk Southern has the highest rail dwell times among all major railroads. We're talking an average of 23.3 hours system-wide and a staggering 40.4 hours at their Decatur yard. Those are serious efficiency bottlenecks.
This master summary table is really the crux of our explainer today. Just look at how far the $340 current market price has detached from literally every single fundamental valuation methodology. Whether you use Graham's formula, the dividend model, or a base case DCF, the intrinsic value ranges from just $130 to $245. The market is pricing this stock purely on the hype of the merger, and even then, it's trading $20 above the actual offer.
So, blending all these insights together, our final verdict as analysts is that Norfolk Southern is a fundamental sell or best a hold if you're gambling on a sweetened merger offer. Value gurus like Buffett would likely wait for a price collapse to at least the $200 level to gain a margin of safety before even thinking about initiating a buy. Graham wouldn't touch it above $100. And Peter Lynch, he'd tell you to avoid it entirely.
I'll leave you with this final thought to chew on. When the market price completely ignores fundamental math, ignores high operational dwell times, and even ignores the exact dollar amount of the merger offer to trade at a massive premium, is Wall Street brilliant in predicting a massive bidding war? Or is this a massive psychological valuation trap just waiting to spring? And if it's the latter, who is going to be left holding the bag?